Hi everybody, this is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 26, titled Selling Cash Secured Puts to Lower Cost Basis. A real-life example with Halliburton Company, which trades on the New York Stock Exchange under the ticker symbol HAL. Now, there are situations when we own a stock in our portfolio and the price declines. Frequently, many investors will turn to options to mitigate these losses. This particular podcast will highlight a series of trades done by one of our members regarding such a situation. First, let's define what cash secured puts are. It's where we sell a put option, which means we're agreeing to buy the shares of stock, or it could be an exchange traded fund, at a strike price that we determine by a date that we determine. Normally, when we're selling cash secured puts in the BCI methodology, we're selling out of the money puts, which means the strike price is lower than current market value. So we're agreeing to buy the shares at a price lower than they're currently trading for, by an expiration date, and normally we do monthly options. Certainly nothing wrong with weekly options if that's what you choose to use, but monthlies is where I've had my most success. Now, the broker is going to require us to put the cash into the brokerage cash account for a possible future stock transaction. So if the put buyer elects to exercise that put, the shares are then put to us at the strike price. Now, the broker will allow us to deduct the put premium from the amount of cash it requires us to put into our cash account. So the formula for the amount of cash required per contract is the strike price minus the put premium times 100. That's the formula. Now, selling cash secured puts can either result in a monthly cash flow if the option is not exercised, or if it is exercised, then we're going to buy the stock at a discount. And that would be the put strike minus the put premium would be our break even or our cost basis if the option is exercised. So that kind of defines the terms of the cash secured puts. Now let's get to John's trade with Halliburton as of October 31st, 2018. Now, John originally purchased HAL, 100 shares, at 46.02. On October 31st, the price had dropped to 35.31, and John was looking for a way to lower his cost basis. So he was looking to then sell a cash secured put. In other words, agreeing to increase his position in HAL, but bring down his break even since the strike is lower than current market value. So what he did was he sold the 33.50 put for 64 cents or $64 per contract. Now we feed this information into the BCI Foot Calculator, and we put in the information that on October 31st, HAL was trading at 35.31, and the 33.50 out of the money put strike was sold at 64 cents. And this represented a 1-month return. Now, if the price of HAL did not drop below the 33.50 strike from current market value of 35.31, exercise would not take place, and the $64 per contract premium represented a 1.95% 1-month return. That annualized out to 23.70%. Now, if the price of HAL did in fact drop below the 33.50 put strike, and we took no action and allowed the put to be exercised, those shares would be put to us at the 33.50 strike minus the 64-cent premium, or 32.86. So the amount of cash the broker is going to require us to put into the account for this put sale is $3,286 per contract. if the put is exercised and shares are put to us at this break-even price of $32.86, that would represent a 6.94% discount from the price of PAL when the trade was executed, which was $35.31. So now, if it was exercised, we have 100 shares at $46.02, and now we have 100 shares at a cost basis of $32.86. So those 200 shares average out to a cost basis of $39.44. So let's look at these strategy benefits from an unexercised perspective. In other words, the price of HAL does not drop below the 33.50 strike. Well, folks, we have a 1.95% 1 month return, 23% annualized. Not too bad. Okay, now let's look at the strategy benefits if exercised. That means shares are purchased at a cost basis of $32.86, the put strike minus the put premium. And that lowers our cost basis from $46.02 to $39.44. That's pretty significant. So if you want to stay with the security and you want to lower your break even, selling an out-of-the-money put is one way to do that. Now, there are alternative ways to do that. That's beyond the scope of this particular podcast, but one I'm sure I'll be doing in the future is to use the stock repair strategy. And there, what we're doing is we're increasing our position by buying a near-the-money call option, close to the current market value of the stock at the time the trade was executed. So now we are long 100 shares of stock, and we're long one call contract. What we do then is we sell 2 out-of-the-money calls to fund the purchase of the long call. So we're looking for a wash or perhaps a slight credit or debit, but pretty close to a break even. And those out-of-the-money strikes are usually between current market value and the original market value of the stock. So that's another way to lower the break even. In that second way, it's without adding any additional cash. You could find out more about the stock repair strategy listening to future podcasts, or you can go to my website, www.thebluecollarinvestor.com, and just put in stock repair in the Google search tool at the top of all the web pages. Now, just to summarize, selling cash secured puts has multiple applications. We could use it simply to generate a monthly cash flow. That's the most common use of selling cash secured puts. We can also use it to buy a stock at a discount for our long-term buy and hold portfolios. Or as in this case, the way John did it, to lower our cost basis of a stock that has declined in value. Now, to learn more about option selling strategies, visit our store, thebluecollarinvestor.com/store. And there we have a multiplicity of educational products, including video tutorials, online DVDs, ebooks, hard-covered, soft-covered books, PDF books, calculators, and so much more. Just visit our store and you can make your determinations as to which products meet your particular strategy guidelines. So I want to thank everybody for taking the time to listen to this podcast, BCI podcast number 26. I hope you enjoyed it. And most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.